The stock market hasn't been the greatest place recently. You see tons of YouTube thumbnails with fire in them, and it's been a lot of volatility up and down. But for the stock market, at least for the past year, it's actually down just a little bit, almost 4%. For this year, though, so far, it's actually up for this year. But if you look back to the peak from when it started coming down, it's down about 15%. And that leaves the question is, should you put money into the stock market right now? Is it going to continue to fall? Is it time to put money in? What could be the best move? And although you should never try and time the market because nobody can do that. That's why the majority of traders lose money and the majority of even hedge funds and professional investors don't beat the market. So the tried and true method is just continue putting money in no matter what, just consistently DCA and don't worry about the swings and invest for the long term. But currently, what if you took just a little bit of a safer approach just because of the things that are going on? You all know rates have been skyrocketing, so everything from mortgages to any debt has been extremely expensive to take. But that also comes with saving accounts actually skyrocketing in what they'll pay too. We can see right here, even just from Ally, if you look at Ally, they are a high yield savings account, and you can see them paying 3.4% just for a savings account. You don't have to have this invested or hold it for a certain period of time like bonds. You can have it literally just sitting in your savings account and get paid every month from the interest that is out there. And that is basically risk-free, right? Up to the FDIC 250K so that you're insured. But this is basically an extremely risk-free rate. And the stock market went down by this much last year. So if we have a similar result, you could actually make money sitting in cash in a savings account instead of losing it in the stock market. And obviously comparing this to the big banks like Bank of America, Chase, Wells Fargo, these guys, I mean, their interest rates that they're paying are basically nothing. So even in general, you should always have a high yield savings account instead of a normal one, because you might as well make money on your money instead of let somebody else make the money. But they're not the only bank that has these great rates like Ally. There's a few, like you can see here. There's a top list here from 3.6, 3.75, all the way up to even 4%. So you could get 4% in a savings account, which is crazy, which is no risk. You know, as long as you're under the FDIC, that is a insane amount of money that you can make for just having your money sitting in a savings account. So maybe a better strategy to this year would be to continue investing, you know, continue dollar cost averaging, but put some of that money into a high yield savings account so that you can get that risk-free return. You can make that interest while actually not, you know, risking it all in the market. You can actually barrier yourself or give yourself a little bit of cushion there and take advantage of the insane rates that are going on right now. Or you could actually even put money into bonds, which is kind of a crazy thing to even think about, but the rates that bonds are paying are absolutely insane. We can look at some of the US bonds. You can see here, just even a US 1-year treasury bond is paying over 5%, just over 5%. So you could put your money in there, earn a guaranteed, basically risk-free 5% at the end of the year. You're good, and that's golden. So if you say, if we had $10,000 and you put it into the stock market and we have a year like we saw before, you would be down to $9,630. But if you took that same 10K and put it into a 5% bond, that would then turn into $10,500 at the end of the year. So you could see why you might want to incorporate a bit of cushion into investing for the near term, at least, because it seems like we are in a crazy time where inflation is running rampant. The Fed can't catch it. And now you can get risk-free 5% returns, which is insane. And even if we compare this to savings account, if you don't want to lock it up for a year or whatever period of time here, you can still get the 3.4%. It might vary if rates continue to go up. It might go up. If rates come down, it might go down. But around 3.4%, you could have the 10,000 turn into 10,340 instead of losing money, potentially losing money, right? I mean, all you really got to do is see the 1 year is at 5%. The 2 year is very close to 4.86%. The 5 year here, 4.249, and the 10 year at almost 4%. So if you want it, this is more for like institutional or tons of money, right? If you have tons of money to put some in 10 years and plan to hold it for 10 years. But I think taking advantage of something like a 1 year treasury or 2 year treasury could be a massive thing in a time when, people are really uncertain. No one knows what the Fed's really going to do, how bad a recession is going to be, and what the stock market reaction might be like. But this, you can at least put in some guarantees, like more risk-free rates of basically 5%. And if you took this 2 year and you locked this in, you could be at 4.86% for the next 2 years and be loving it, right? It's not something that is going to just plummet. And if you hold on to 2 years, you get your percent. So even though you should never try and time the market or try and time buying assets, that doesn't work. You could take a little bit of whatever you were going to put into stocks and stuff, or the S&P or an index fund. You could take some of that and just put it in a savings account and save it and just use it as buffer in case the market's going down. At least you have that, which is pretty much guaranteed to go up and pay that interest out. Same thing with bonds. If you put a little bit into bonds, you could have the 5% interest rates for 1 year, 2 years, and then you could be good. You could walk out and know that at least a portion is actually protecting your overall portfolio, your overall kind of investments or your consistent investments. At least you can take some of it and put it into kind of a risk-free return, especially something like a savings account where you can always withdraw the money if you need it or if you want to. A bond gets a little bit more difficult. You obviously, if the rate goes up, the value of your bond goes down. If the rates go down, the value of your bond goes up, and you could probably sell it for more than you paid for it. But this is obviously, a crazy time where you can get some crazy interest off of things that are relatively safe. But still, don't let that stop you from putting money into the market or putting money into assets, because you shouldn't stop just because you're worried or something. That's probably the worst time to stop. You should continue dollar cost averaging, but take a small portion, throw it into a high yield savings account, and put a little buffer in there. That's going to do it for this video. As always, don't forget to smash the like button and subscribe. I'll see you guys in my next video.